Welcome, everyone. Diversification is a very known term in the financial markets. It's not something that we have not heard before. If you have your portfolio being managed by someone, your fund manager will speak about diversification, your traders will speak about diversification. And that is something which is always be very significant. It will always be very important, and it's going to be a major part of your investment. And when we talk about diversification, in layman terms, it's just a practice of dividing your money among a lot of different types of investments, right? So basically, I'm sure you feel that probably gold prices are going to go up or maybe it comes down. If you are not sure about it, you invest your money in gold, but similarly, you invest your money in some stocks, in some bonds to make sure that if one of your bets doesn't work, then the different sector or a different asset class might work. And that is something which is really important because stock market specifically at this moment is lot like riding a roller coaster. There's plenty of exhilaration. You have goosebumps, sometimes butterflies in your stomach when you're looking at the market. But then diversification makes this ride pretty smooth. And the basic idea is if you have different investments and the value of one goes down, then your other investments can help stabilize your portfolio's overall returns. And that's what we are trying to achieve. We are looking currently a very high inflation environment. And how the diversification basically works, you investments don't usually move as a group. And let's say if oil is down, then tech stocks might be higher. If oil is going up, tech stocks might be down. If smaller company stocks, for example, if they're struggling, probably large companies could be doing well. So if one of your investment loses value, other might decrease less or at least hold the value or even increase, which is a win-win scenario, right? And you can please remember this, whatever I'm going to speak in this webinar, uh, you cannot basically eliminate the market risk. Market risk cannot be eliminated. And whether it is market risk or investing risk, it cannot eliminate it. But diversification actually, from a very significant point of view, it can reduce that risk. More you spread out your money, the less likely a dip in the market it will tank your portfolio. So basically, that's what we are trying to achieve. We are trying to understand what are the benefits of diversification, what are the ways you can diversify, right? And that is something which we are trying to achieve. So I'm going to share at the end. I'm going to share a portfolio also. There's already a question here: is it okay to buy gold bars for investments? Um, yeah, but the only thing is, as long as you have your quantity decided. And so this is how it works, guys. If you have any questions, continue to put in the question bar, and I can try to answer as when the question comes in along with the presentation. So if any one of you has to leave real quick, you have your question answered. In either case, if you want a one-on-one session later on after this, I'm readily available. Please speak to your relationship managers, and they will definitely help you out in setting up a training session with our team, right? So is it okay to buy gold bars for investments? You just have to decide a quantity over it. It's not a bad thing. Gold, at the end of the day, it apart from being a safe haven, it also has a certain amount of sentimental value attached to it, emotional value attached to it. You see Chinese New Year, gold prices go up. Indian festivals, wedding seasons, gold prices go up. So we always can be on that side, but again, as a diversification tool. And the idea is, as long as your quantity is sorted, because when you buy gold bars, the only problem is where you're going to store it and the safety of those. So a lot of my clients, they go with online buying and selling because it's easier for them to do in large quantities. Plus, it remains in your trading account, so the storage is not a problem. You can easily buy and sell whenever you want. There is no physical market timings involved because gold prices on an online platform kind of runs 24 hours. There are questions: when should I buy and sell? So that is a more technical perspective, but we'll try to throw light on that as well. Um, we have another question: which sectors are right now having good prospects in Indian stocks? Again, something which we can definitely answer over the period of session. So great. As we talk about diversification, we understand diversification is also a way to manage your risk, and risk management is something which is really important, right? Because at the end of the day, whenever we are investing, we have to see that whichever sector we invest, we have to manage our risk. Always focus not on making profit, but on minimizing your loss. This is something which I have seen, and this is something which I have practiced also over the period of years. That if you're focused on minimizing your loss, returns can come and go. But at the end of the day, as long as your loss is minimized, this is something which definitely can be taken care of. Now, let's understand how do you achieve portfolio diversification, and this is something which we have seen. Every single person over here has to understand one thing, that you don't directly jump into stock markets unless you have that money uh, which is ready to be exhausted in this risky area. Look at this investment pyramid which I'm showing it to you right now. The very base of that pyramid shows that as long as you have your fixed income investments with you, you have your savings accounts, you have your fixed deposits. I'm sure a lot of people here, they have fixed deposits, probably in their respective home country, in their banks, and that is the money which you have just kept aside, and you should have that. See, a lot of people would say, why you're keeping your money in the bank, inflation beats it. I understand, but at the end of the day, there should be a significant amount which should be kept safe and secure in a bank, in savings account. Even if interest is something which is not your forte, you still have some money aside which is earning you, uh, even if a negligible fixed income, but that is the money which is kept aside for your rainy days, sometimes rainy years. So one thing pandemic taught us was first to have an emergency fund for ourselves. A lot of our friends or family uh, acquaintances, they lost their jobs during the pandemic, during the lockdowns, and so many of them learned new talents, whether it was about making coffee or dancing or singing. But the whole point was that what happens when suddenly your income stops? So you need to keep some money aside, and that money is not about investing in stocks all the time, because when something like pandemic happened, we saw stock markets also crashing. So that money is something which is separate. If you don't have your pyramid base, then you have to think about it first before you start directly investing into speculative markets like stocks and commodities and cryptos, etc. Once you have your investors base done, then you try to locate some of your funds into high grade municipal bonds, fixed income bonds, which gives you certain amount of interest. Could be corporate bonds also, which higher yield. For example, at this point, Citibank, FedEx, these kind of companies have issued bonds which have higher yields than government bonds. You want to be much more safer, you can invest into bond funds also. I'll share a portfolio with you which has some bond funds as well. And then you move to a point where you start investing into real estate. That's you see that the tip of the pyramid is the savings, then goes with high grade municipal bonds. Then you go for the blue chip stocks. These are the companies. These are your companies like Mastercards, Visas, or um, Pfizer, Johnson and Johnson, Apple, Microsoft. Blue chips, which are part of US 30 or the top 30 companies of US, along with your real estate investment trust or real estate investments. Then on the top of this pyramid, that tip of the pyramid which you see, is speculation, trading in commodities, trading in options, trading in stocks. And when I say trading in stocks, that means continuous buying and selling, kind of trading in future contracts, doing strategies. That is the tip of the pyramid. From the bottom to the tip, we see the returns, they increase. You get returns over here in bank accounts. Probably you will not earn too much money as compared to stocks or real estate, but then the risk also increases. While your money is much more safe in terms of a credit risk in a bank account, or your capital is safe in a bank account, stocks might yield to a higher risk. Nothing is risk free, But again, if we see the relative risk, when we compare banks to stocks and commodities, obviously there's a large gap in the risk and the reward. So risk increases, reward increases. Another question here: buy gold in low and sell it higher. Write that how it works. So, if you want, I can give you a demonstration also on the live platform, and that is something which we can do. We can show you how to buy and sell in the live platform. It's more easy. We'll explain you how margin trading works, and that will also be available in this session. Now, one way to diversify your investment. So there are different ways you can diversify, and it just not does only happens on the asset ways. It can happen on a sectoral point of view also. Like for example, if there is an investor who has invested in a big tech company, for example, right? And then there's another investor who has invested in a mix of stocks, bonds, real estate, little bit of big tech company. So tomorrow, if the big tech company falls down by 50%, then investor A's portfolio will fall more. But then the other side, if there is an investor B, he will be able to have a reduced risk. And that's why we diversify. So you can spread your risk on the basis of geographies, right? US is one of the greatest places to invest. But then there are other countries also which have fared better returns. Somebody just asked a question about Indian stock markets, which we are going to answer as well. So if US hits a recession, you should have your investments in emerging markets in different parts of the world that can happen. Yes, US becomes a center point, right? It definitely becomes a center point because today, if you have a Netflix account and you have an account on Facebook or WhatsApp or Instagram, if you have taken a Pfizer vaccine, you have a debit or a credit card which says MasterCard or Visa, you travel through a Boeing airplane, right? You use a Microsoft system, you have an iPhone, all of that. From your eating McDonald's or KFC to wearing Under Armour shoes, everything is a US stock. So we are already using a lot of US products. And this is something which is, I should say, this is one of those things where we kind of deny. Why? Because we are already using these products, but then somehow we refuse to invest in these markets due to probably lack of knowledge, or we think it's high risk. Risk is everywhere in every market. So today, what we have to understand is a lot of times we have to see that which phase of economy we are in, right? Sometimes we are in an economy which is accelerating. Sometimes we are an economy where the growth is coming down, and the sectors change. Somebody asked the question, which sectors are right now good or bad? So if you see from a sectoral point of view, when there is an acceleration in the economic growth, when we see markets also going higher, when we see a lot of stocks are going higher, that's where we understand that if you are looking at a consumer discretionary, if you're looking at financials, if you're looking at industrials, you're looking at IT sector, you're looking at materials, you're looking at real estate, these are the sectors which go higher. And that is where we have to see that if whenever the economy is at early phase, when everything is growing, a lot of people would invest into, let me just switch off so you can have a better look. I'm trying to make this a fuller layout. So if you see, currently, when you are in the early stages of economic recovery, you start investing into financial stocks, luxury stocks, industrials, IT, technology stocks, basically, what we have seen. And look at the sectors which can be avoided: energy, healthcare, and utilities. So this is in the early phase, right? I hope everybody can see this right here. Now, in the mid side, we see when the acceleration pace is stable, okay, and we see that economy has already grown and now it is at a saturation point. That's where you will see the growth is positive but very moderate. So you're looking at the services like communication, still looking at IT. This is where you start avoiding the luxury stocks, okay? And then we see growth rate starts slowing down. So the curve which you see, which is going down, is not that the growth is going negative, because that would be more of a recession. Right now, the growth rate has started slowing down. So earlier, if the economy was growing at a rate of 3%, now it is around 2.5 or 2.4. That's where you should start investing into energy stocks, consumer staples, and consumer staples are these defensive companies, day on day. So if you require a day on day products, like whether there is a recession or not, you're still going to buy a toothpaste, right? If there's a recession, and if you like to drink Coca-Cola, you're not going to stop drinking Coca-Cola. So there are few defensive sectors, consumer staples, your daily food stuff, which is always there, and consumer staples is one sector which you should start looking into once you see that the growth rate is slowing down. Then there is healthcare, there is materials, there is utilities. And again, tech stocks and luxury stocks should be avoided, which is consumer discretionary. And again, when we see the growth starts contracting, when we feel that we are in a recession, again, you focus mostly on utility companies, electricity companies, or consumer staples, or healthcare companies mostly. And you should avoid factors which are related to real estate or industrials. Technology, if you see, the moment the growth starts slowing, technology is out of the question, right? Now, there will be a lot of questions about that the top 10 stocks or the top 5 stocks by way of market capitalization are technology stocks. Microsoft is $1 trillion company, Apple is $1 trillion company, Amazon is. So, how can we be away from this? Now, to those investors, it should be more of a buy and hold situation, but you have to consider that risk. Like, for example, tech stocks started showing decline last year, late October, and since then, Nasdaq has continued to fall in down. Nasdaq is the index which is tracking the technology companies, and a lot of tech stocks have started coming down. So if you have that mindset that these are the bigger companies, always cash rich, I'm going to buy and hold on to it, you can, but then you have to understand that a bear cycle, a secular bear cycle, bearish means going downside, because a bear attacks like this, so it's called on the downside. It can be for a few months, but can be for a year also, or more than that. Pandemic spoiled a lot of investors. We started thinking that there's going to be a V-shaped recovery every single time stocks crash. So a lot of investors got into it. That every time stock market used to come down 5-6%, they would buy thinking that it's going to go up. But now the condition is completely different. Yesterday the inflation data came out. It's way higher than expected, and central bank could raise more rates, and that is going to impact stocks a lot more. But the stocks which have good dividends are the ones which have low volatility. So at this point of time, what sectors you should be looking at is the one quality names giving you fixed dividends and less volatility. Tech stocks are quality, but they are not less volatile. They're high volatile. You see the likes of Netflix and Amazon's or Walt Disney, these stocks, they move a lot, they fluctuate a lot. But if you see stocks like ExxonMobil, or if you see stocks like Coca-Cola or Verizon or Vodafone, these kind of companies, they move very little and they give you a fixed dividend. So I have a dividend portfolio also to show you by the end of this presentation, and you can look into it. To strategy wise, if you see, if you are somewhat of a defensive sector where you think that economy is slowing down and your goal is basically to reduce down your volatility, reduce down your risk, then what you can do is typically invest in the sectors which is presented here on the slide: utilities, consumer staples. Consumer staples are, as I said, your day-to-day products, healthcare. But if you're thinking that the economy will start growing, and if you're anticipating a growing economy, and then you should start looking into tech stocks. Then you should start looking into financials or luxury stocks, which seems to be more opportunistic if you're expecting a growth in the economy. Then there are people who, so this is important right now, because if you expected that inflation would go up, which has been happening since last October, you should look into stock sectors like energy. Energy sectors have grown because oil prices have started going higher. So we have seen energy, we have seen materials, we have seen real estate Also real estate equities, real estate funds also started going higher. And these kind of sectors, they usually outperforms the market when the growing economy leads to inflation, because the prices of raw material starts going up. So in a high inflation market, energy stocks, uh, this is something which can affect, could be a good positive idea. Materials, real estate, that can be a good idea, and that is something which you can look into. Now comes another way of investments. So far we have understood your basic conventional ideas how you can invest into the market, right? There are ways you can buy these stocks, you can buy these ETFs, and then there are strategy based products also. We'll discuss a few strategies. Let me just share with you a portfolio before, since we have definite time here. So this is a portfolio which has been recently prepared, and you can look into this. I hope everybody can see this. Right here. Okay. So now this is a ETF and bond portfolio, REITs portfolio. And here, what you see, REIT stands for Real Estate Investment Trust. And this is a portfolio which we recently prepared. You can take a snapshot of this or note it down, or if you want, we'll be able to send you this PDF. We prepared it for a couple of clients, and definitely that's why we are showing it to you. Uh, uh, One common feature about all of these funds is, again, the volatility is normally less. And when you see their market cap and when you see the dividend yield, so I'm looking at a different REIT stock at the moment. Let me just make sure that we get a good speed here. Okay, great. Yeah. So we are looking at different amount of REITs. Rhythm Capital Corp, Medical Properties, Trust Inc., Simon Property Group Inc., Highwood Properties Inc. And I will give you a minute to see the dividend yields, which is in the fourth column. Everyone, just look at this, and let me zoom this so you can have a proper look. Take a picture if you want today. Just take a snapshot right here. I'm just going to give you some time. Right? So I hope everybody is looking at this. Look at the 52 weeks high and 52 weeks low. So if you see from a market capitalization size, uh, it's pretty fair. I mean, these are not small cap. We could tell them these are mid cap areas. Look at the price targets, the analysis on the price targets, what the target is at the moment, right? And then this is a small description about all of them. So Rhythm Capital, for example, if you see, the company rebranded itself as Rhythm Capital to highlight its diversified business opportunities and triggered the management internalization, right? The Q2 financial results, if you see, showed the total revenue of 1.3 billion. It has exceeded the market consensus. So a lot of times there are market expectations. If you see, they have made a significant headway. Look at their ended. So the ended quarter is still in a loss. But at the same time, if you see the ratios and compare it with the industry ratios, so P ratio is it's a financial tool where you will see that what is, so to identify the how much it is undervalued as compared to the market, you see PE ratio of a company. So from a ratio point of view, you see that if the industry shows a ratio of 8 and the stock is priced around 4.6, then that is where we have to understand the stock is currently undervalued at the moment. Now, the dividend yield, if you see in this, is around 10%, right? This is somewhere around 10% of yield, which is available. So we are looking at, again, real estate investments. We are looking at a decent yield of around 10%. Then there is medical property trust with 7% yield. There is Simon Property Group with 6%. And so this is the annual dividend yield percentage. So how dividend yield is calculated, somebody just asked in the question. So not to go very technical, dividend yield is more like whatever is the total net income, uh, right? And like the total, you distribute it by the number of shares, whatever is the total dividend you are about to give. So that's how we calculate the dividend yield. So for example, if somebody is distributing 50 cents in the dividend quarterly, dividends are mostly paid quarterly, and if you are doing 50 cents of dividend over the period of year, we will see uh, 50 cents every quarter. So 50, 50, 50, around $2.5 or $2 is what the dividend will be on each share. So these are some portfolio ideas which you can look at. And obviously we'll send you this portfolio and look at the description. Medical properties trust, for example, this is one which it's a global provider of real estate capital to hospitals. Now that is again the healthcare sector. You follow further, you see Simon Property Group, which means a lot of this group basically develops, it manages retail real estate properties, regional malls, outlet centers, lifestyle centers, international properties. And 95% of their revenue comes from leasing income from around 200 properties in US, 100 international joint venture properties. And if you see from a dividend point of view, Simon Property Group, it's giving us 6.7% yield. This is again, guys, just for your perusal. Uh, this is something which all of us, at some point of time have known, but we ignore because sometimes the volatility is not too much. As an investor, you want to see your portfolio moving a lot, but then we have to understand that more or less we need stability as well. So you start looking for those sectors which give you decent yield and are not volatile. When should I buy and sell? I would like to know about it. Definitely, sir. I think we are going to switch to the live platform and I'm going to show you when you should buy and sell. That is also, we'll discuss both fundamental and technical perspective for this. Then followed by, again, Highwood Properties Inc. So this portfolios, this is at the current market price. We have prepared for a few of our clients. So this is something, if you want to start now, you can. But before that, please talk to your risk consultants, understand the risk and reward, and only then do this. So there is Highwood Properties Inc. There are different industries, Essential Properties Realty. All of this, the consultants can speak to you what sort of properties they have, because this is like a trust. So if you buy an actual real estate, you face dilemma of liquidity, right? They are highly illiquid assets. You cannot buy a property today and sell it tomorrow. But with real estate funds, this is something which you can buy and sell. These are available on your platforms and you can easily buy and sell given the amount of time. Then comes some municipal bonds. Now in municipal bonds, we have seen uh, BlackRock taxable municipal bond. Then there are, and all of these are bond funds, all right? A lot of these bond funds have an advantage that there is no city tax or AMT tax, which is normally charged on a lot of bond funds. And these are municipal bonds and they don't have those taxes around. And the dividend yields are, again, if you see the third column, around 8%, 4.5%, 5.5%. This is something which is available, right? And there are dividend growth expectations. So this is something which we have seen overall. Look at the price charts. Will, again, as I said, we'll give you this presentation before we move on to the live platform as well. And last but not the least, we have ETFs. Now, within ETFs, we can see that there is a healthcare sector. Healthcare sector is important, but when we see a specific stock, specific stock will always have a risk. So I talk about diversification, I talk about risk management. Investing in one individual stock still makes you vulnerable, right, to that security specific risk. But when you see a fund like Consumer Staples Select Sector SPDR fund, now this has 2.5% yield, right? The current market price is around 74, 52-week low and high. I think it's interchangeable. So if you see healthcare sector, 52-week high is 143, 52-week low is 118. 52-week high for consumer staples is around 68, and 52-week low is around 31.34. So this is something which we are currently looking at, and these are two ETFs. Healthcare Select Sector Fund. Uh, so we are looking at completely from the healthcare sector point of view. Uh, S&P 500 index aims to provide precise exposure to companies in the pharmaceuticals, healthcare equipment, supplies, healthcare providers, services, biotechnology, life sciences, healthcare technology industries. And this is one idea, because when we are looking at a healthcare perspective, we are looking at an idea that, am I investing into only a pharmaceutical company, or am I investing into a company which provide healthcare services, or biotech companies, or those companies which are even providing healthcare equipments? So a fund takes all these sectors together, and within the sector level, it diversifies your risk, that you're not only looking at, like what happened in pandemic. Everyone in the pandemic, when they saw these companies, all the vaccine companies like Novavax, when they started going higher, Pfizer for that matter, before the vaccine was introduced, people started buying those companies. And we saw increase 100%, 200% increase in the pharma stocks. But the moment vaccine was introduced in late November, everybody asked the same question, that should we buy pharma companies now? But the problem was that after that, the stocks did not go up that much, because that movement was already priced when the pandemic happened. Even before the vaccine was introduced, people bought pharma shares, they booked their profits, and when the vaccines were actually introduced, there was not such movement. In fact, the stocks went down. So what we have to understand is, by taking exposure in the fund, not only we take just pharmaceutical companies, but we also take those companies which are making healthcare equipments, those companies which are into biotechnology, life sciences, and other areas, right? So this is something what we have to understand. And similarly, if you look at consumer staples, now consumer staples stocks, you're talking about personal care, soft drinks, tobacco and food products. And these are, as I said, those companies which tend to outperform in a volatile market scenario. And because these are, again, defensive sector, right? And sometimes when the investors are in panic, they try to invest into more into defensive sectors. And that is the reason that why consumer staples is also available in the portfolio. So if you're talking about, again, guys, on the value system, if you feel that tobacco and alcohol stocks is something which you don't want to invest in, then don't do the consumer staple select sector. We will have another fund for you, which will be completely related to very specific sectors. If you want high dividend portfolios, we have high dividend funds also, which you can invest into. So that is something which is really, really important. Now, I'm going to take you to the live platform and explain to you, when do you buy, when do you sell, as a lot of you asked. We're going to look at gold chart also on day-to-day basis to understand, and then I'm going to do a few strategies here. Okay. And I'm going to tell you how do you buy and sell, and then afterwards, if you have any questions, I'll be more than happy to answer. We'll talk about also what is there for the Indian stock markets, what are the sectors which we can look into, and that is also something which is coming. Let me just share this. We are going to log on to the live platform. Right here. So for those investors who have not seen this platform before, let me just share this and tell me if you can see this right away. Perfect. So wait, please tell me if you can see my screen. Send me a yes or okay if you can see this. Please guys, let me know if you can see this. Send me a yes or okay if you can see this. Okay, okay, okay. I can see a lot of you can check this. Okay, perfect. If it is visible properly, that's most important. Now, normally when you open your accounts, trading accounts, it contains user ID and password. Okay, and normally the user IDs are your emails, but since this is a demo account, so I'm just gonna put a demo account into perspective. So let's say I'm put and these demo accounts are free of cost, so you can speak to your relationship managers and they will give you free of cost these demo accounts, and you can trade and try. Basically, when you trade in a demo account, it's not to see whether you're going to make money or lose money. That is only to make you familiar with the platform. So never think that if you have made money in the demo account, you're always going to make profit. If you have lost money in demo account, you're always going to make a loss. It depends upon how you react in the live market. Your emotions are the most important thing. Demo is just to try a lot of strategies, see how it would have worked out, and that's all. So currently we are looking at it. It's a very easy platform to look at. Okay, and this is important for me to show you because a lot of you ask that how do you look into a daily market and buy and sell. So here it is. Let me just bring this to everybody's perspective. Okay. Now what you see is a big product library right here. It has commodities, cryptos, currencies, ETFs, and since a lot of you talked about gold, so we look at gold right here. We search for gold in the search area, and this is gold cash. We click on it, and a chart appears. Now, technical analysis, guys, it's a very big area of understanding. So I'm not going to bore you with the technicals, how it works. In fact, if you want to learn more about technicals, I'm available for a one-on-one session whenever you like to, because it's a pretty vast area. All I can explain you right now for the charts is this movement, what you see, it's like a pulse rate. So if you want to see, you want to check your heartbeat, you do a ECG and you realize how your heartbeat moves, right? And that is something which is exactly how a stock also works. A price of a stock is just like a heartbeat of the stock. So the way the price moves, it is recorded in this particular map. Now, when you have to take day-to-day trading decisions, you don't look at a very long-term chart. So let me just increase the size of the text. I'll just increase the font from very small fonts to very large so everybody can see this. Now on these charts, you can see every single day how the market has moved, what price it has opened. So on the right side, it is the price. On the left side is the month and the date at what price. So for example, I select this. Now, if you see, if I put on this particular line, it shows 13th June 2022, gold prices opened at $1,875 per ounce. It went as high as 1879. It touched a low of 1818, and then it closed at 1819. So it opened at 1875 and it closed at 1819. That is a good $50 to $60 movement. And let me tell you this, $55 $60 movement is not something gold does every day. Normal average movement in gold prices could be around $15 to $20 very easily day on day. So when you decide on your quantity, you have to understand that if you're buying 10 ounces of gold, be ready for a $200 profit or a $200 loss, right? That is something which you can always make sure about risk and reward. Now, because we are looking at a very short term, I am reducing the duration of this, and I'm looking at, instead of 10 months or 1 year, let's say I'm just going to look at 3 days of how gold prices have moved. Now just look at this big drop. I'm not sure how many of you can see this. Let me zoom this up. Look at this. I'm just going to bring this in center. Look at this big drop. Now, this big drop, what has happened, and this has been on 13th September, gold prices went down from 1730 all the way to till 1697. Again, $33 of movement, right? It happened right there. And this, again, guys, as I said, this happened yesterday when inflation data came out at 4:30. Look at the time. 4:30 p.m. is when the inflation data came out, and it showed that inflation is increasing, which hinted that central bank might increase rates higher. And whenever there is a high interest rate environment, we see commodity prices like gold coming down as they're valued against dollar. So the moment that data came out, we saw a big drop on gold from 1732 all the way to 1697. Now, if I consider this drop and see this has been a very, very big drop, and after that, if we see, gold prices have just continued to move like this, just in a range. Let me zoom this out. Look at this. This is what the movement is. Now, on day-to-day basis, if you have to take a transaction and it's for today, for example, so what you normally do is just try to see that what are the prices from where gold prices are going down and coming back from. And this is again, guys, for day-to-day traders that just see I have made this support line over here and see what's going on here. Look at this price level. It's somewhere around, actually it should be slightly down. Let me delete this and put another one right here. And this is not something which only traders can do, or this anybody can do this. This is all about just identifying the points from where it bounces back. Like in this case, one is this, and if you see, one is right here, right? Look at this. I'm going to zoom it for you. Look at this. Now this is the price which is around 1703, and this is the price which is 1698. So we see that since yesterday till now, gold prices have touched, and this is every 5 minutes chart. I'm looking at a very small interval. So whenever gold prices have reached 1697, it has slightly bounced back. So here, 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 and then again it came here and bounced back. Again, it came here and bounced back, and now it is around 1701. So primarily, if you are a day trader, you should be looking at a small buy at 1697, but keeping a stop loss below this as compared to your risk. If you're buying 20 ounce, your risk is $100. Then when you buy at 1697, you keep $5 down as stop loss. Trading without stop loss in a day-to-day market, it is inviting for losing your capital. When you put a stop loss and if it gets hit, you lose a smaller amount of money, but that is a part. This is how exactly every business works. It's a profit and loss situation. If you're looking from a long-term perspective, like a lot of investors, they want to buy gold for a longer period, then you have to look for stronger support levels. Then you have to go back, look at a yearly chart at least, and see that which are the good levels. Now I'm looking in last, say this is September 2022, so I'm looking at September 2021 right here. And if you see this, and now it kind of confirms right here that a good level to enter into the gold prices would be around somewhere this level, which is 1680 right here, 1680, 1682, right? Maybe 1697 is not that great. It still looks like it touches and bounces back. But then from a technical perspective, 1680 is a decent level where you can enter. And similarly, the profit booking also. So if you see, just like a support, there is something called a resistance, which if I were to show you, just look around, say these levels, or from a long-term perspective, I think this is very suitable, 1830, 1840 levels. Now, I'm giving you a buy of, not basically recommending you. Again, whatever I'm telling you, it depends on how the market moves, but please, this is only for information purposes. A good support at 1682 shows that it's a decent buying level, and a decent profit booking should be at 1838. So there's a big gap of easily more than $100. Now, is this $100? I'm not expecting another day or 10 days or 20 days. That's why I'm looking at a long-term chart. I'm looking at a yearly chart. So for those who want to hold their positions for that long, should try to enter looking at a long-term chart. But if your trade is for today or for another few hours, then you should not be looking at this long-term chart. You should be looking at a chart of the price movement of what happened probably in last 10 or 12 hours, because that's your idea of trading, right? So this is something which we have to understand when we are trading day on day basis, and this is about trading and speculation, right? There are a lot of speculations also which happen. So again, guys, as I said, it will always going to be a hit and trial, but then we have to understand that what is the best way. Don't only just be a trader or speculator, just try to make sure that you actually can, when you are trading, a part of your investment goes into your long-term stocks, dividend yielding stocks, then a part of your income goes into strategies also. Now, how strategies work? Very simple. I'm just going to take a quick poll to understand this one. Do you know about short selling? I have started a new poll, if you can see right here. Just try to answer this question so I will get an idea of the room, because strategies are mostly based on you understanding what short selling is. Just try to answer this question, guys. It will be easier for me to get the idea of the room, that how many of you are aware of the short selling and how many of you are not. Okay. Yeah. Okay. So I think it's a 70-30 ratio. No problem. 70-30 ratio, and still want to make sure that everybody understands this. I'm just going to give you a very quick brief about how short selling actually works. Right, just give me 1 second. Okay, so here, I think let me just close this poll. Perfect. So I see it's a 70-30 ratio. I'm quickly going to explain you how short selling works, because all our strategies, most of the fair trading strategies are based on you understanding short selling. Now, for example, look at this chart. Gold prices right now are at the downsides. You're expecting it, okay, if you want to buy. But imagine if gold price were here at the top. Let's say, let me draw a line on this, because now you see the chart. Look at this line, price of 1973. Okay, look at this entire line and write it on your chat. If the price was here at this moment, would you buy gold or would you wait till it comes down? Look at this chart and look at this chart, look at this price, 1973 right here. If the price was here at the moment and you were an investor and you would see this chart and you would see the historical chart, would you buy at this moment or would you wait for the price to come down? There are no right or wrong uh, suggestions, because everybody will have its own view. Okay, just look at the blue line above. Let's say the price was there. What would be your view on this? Would you buy right away? You wait for the prices to come down? For those investors who would buy, of course, that is again a market direction. That's, I'm sure that you would do research on it and you would definitely go for the trade. And there's nothing wrong in it, because a lot of factors would come into the picture. Like in pandemics, prices would continue to skyrocket, right? But if we see from the technical perspective, uh, the price is at a resistance point, which means that historically Whenever the prices reach to this particular level, it tends to come down. But as I said, if you wait for it to come down, if it doesn't and it goes up, there is an opportunity which you missed. Now, here is where we talk about short selling. Short selling is the way of taking advantage of the falling prices. So when you anticipate that gold prices might come down, what you do is you borrow some gold from your broker and you sell it in the market. And when the price comes down, you buy it back at a cheaper price, keep the price difference, and give gold back to your broker. Obviously, there is no physical exchange of the commodity. It's only the cash flows which are matched. But at the end of the day, you get to take advantage of the falling prices. Let me show you how you do this in the live platform. It's very easy. So you have $100,000 here in your account value. You can see right now. You click on the selling prices right here. This is buy, this is short sell. And when you are buying anything, it becomes blue. When you're short selling something, so short selling, the main question is how can you sell something which you don't own? Answer to this question is you sell something which you don't own by borrowing it from your broker. So you borrow gold from your broker. Let's say 1 unit means 1 ounce is equal to $1,703, and you want to short sell 20 ounces. So 20 ounces multiplied by the price will be $34,000. Now, what you can do is you borrow this gold from your broker and you click on the sell right here. The moment you click on sell, 2-click process, you sold gold. You can check your account position, go to your positions, and you can see that you have sold gold. Now, see this S20 total value, the price at which you sell. And right now, the buying price is higher than the selling price. That's why you see a loss of $7. But when the price comes down, you will see a profit. So, how short selling actually, this you can do in oil, this you can do in stocks, you can do this in S&P, NASDAQ. If you're anticipating prices are going to fall, you can do this in different asset classes, right? That is why that's why a lot of people, they would prefer to trade in gold. Somebody asked me the question that if I want to buy gold TT bars and hold on to it, you can do that. The only thing is if the prices come down, then of course you have the physical gold with you. You can always use that for some of the other things. But if your primary motive is investment and speculation, then rather than buying a physical gold, online platforms are much easier. There is a leverage available, but leverage is completely optional. If you don't want to take leverage, just buy or short sell the equivalent amount of value, the money which you have put, and or less than that. So taking higher risk or not, it depends absolutely on you. And there are consultants over here who can always advise you about whether or not to take leverage, how much to take leverage, and again, that is something which is more and more optional, right? So over here, what we understand is I have taken a transaction which is short sell. That means I have sold gold by borrowing it from my broker, and the moment price comes down, I can buy it back at a cheaper price, keep the price difference with me, and gold goes back to the broker, right? So when I buy it back, it doesn't mean that I'm buying it back and keeping it with me. It goes back to the broker where it came from. So it's a reverse cycle. Instead of buying first and selling later, what we do is we sell first and then we buy later, but we anticipate prices to fall. Now, when everybody has understood this, here's the strategy. Strategy is called pair trading. Let me show you the slides first, if I can. Okay. And pair trading works on a premises that there can be two asset classes with similar attributes. Now, these attributes can be related to their product. So when I say Pepsi, immediately the next company comes into your mind is Coca-Cola. When I say MasterCard, immediately the next uh, thing which comes into your mind is Visa. Like this, there are a lot of such stocks which tend to move together in a similar direction, right? But these are not the same companies, but they are very close to each other. they have the same product, they have the same regulation, they have the same target market, and that's why these stocks continue to move together. Sometimes the stocks, they move in different direction due to price anomalies. Like for example, Pepsi and Coca-Cola going together, but let's say, I'm sure everybody has heard this incident when Ronaldo attended a press conference. He removed the Coca-Cola bottle and kept water over there. At that particular day, Coca-Cola stocks came down by almost 4 or 5%, right? So, but quickly, when you see that post that fall, Coke immediately recovered the next 2 days. So during that time, if Pepsi and Coca-Cola were moving together, we must have seen. Okay, this is where I need to show my hands. So if Pepsi and Coca-Cola, they were moving together, we would have seen Pepsi still going higher and Coca-Cola going down. This is where we will see an opportunity where we will either short sell Pepsi or buy Coca-Cola, because this gap is eventually going to close, because that's how the historic movement has been. Now let me take you to the platform and show you that how you take this trade. Now, how I explained you Pepsi and Coca-Cola, can anybody tell me which are the two crude oils that are traded on the exchange? Two crude oils which are talked a lot about. Please use your chat options to write it. Anyone? You can Google it and put it also. Two oils which are traded the most. Which one are those? Okay, I start getting answers now. Okay. 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 And good, good. Can I Google it? Of course you can. Please. It's not an exam. I'm sure you have taken out your time to learn something. So definitely, please Google it. Tell me, what are the two kinds of oil which are traded mostly? Perfect. Okay, great. So a lot of you answered here. Okay, okay. US oil, WTI, Brent, UK oil or Brent. Absolutely, absolutely. Great, great. So, so somebody just wrote ADNOC also. Now, when we speak about uh, ADNOC, again, the oil, if it is coming, so basically Middle Eastern oil, Saudi, Russia, it's Brent. The oil which Shell produces in US, that is US oil. Both of them are traded. Brent or UK oil, what we call them, is a kind of a benchmark. Now, these kind of oils, they are traded, and at the same time, both of them are traded. And look how it appears on the platform. Look at this. So I search crude oil, and I have one which is called Brent oil right here. And then there is something called crude oil West Texas or US oil right here. Let me just check the expiry of this. 19th September. Okay, we still have some time, but then let's take this trade. Okay, now look at both these oils. One is 95.17, another is 89.48. If you calculate the price difference between these two, let's say roughly $6, right? $5 or $6. This $5 or $6 difference is what has happened now. If you see this historically and just a few months ago, and even if you Google, so if you Google the oil spread chart, oh sorry, I'm so sorry. Good. Somebody pointed out I forgot to switch the screen. Let me 1 second. Screen right here. Yeah, I hope now you can see this. Perfect. Okay. Yeah. So you see both these oils right now. One is 95.26, another is 89. So odd $5-6 difference. And I bet you if you Google oil spread chart, spread means the difference between the prices of both these oils. And if you see the chart, you will see that from 2016 till 2022, there have been times that this price difference has been fluctuating so much. Like back in 2018 and 2019, this price difference was $10, $11. Before that, this price difference was down to $1.5. So how strategy works is, can you talk about the buy and sell in an easy way so we understand? Okay, I'll try to do my best. But in case if you feel that you're not able to understand in this session, definitely we'll have a one-on-one session. I'll break it down for you. Not a problem. So let me just tell you once again. Okay, let me just tell you how do we buy and sell this. So what I was telling you about, because this is a diversification based session, so we are bound to talk about a few strategies. Obviously, as I said, that you don't have to imply it right away. Come to our office, speak one-on-one with us, and we'll definitely explain you this in a further way. Right now, what we are looking at is, we are looking at Brent oil, we are looking at West Texas oil, which is WTI. Now, the difference between these prices right now, which is $5 or $6 around, this gap has been $1 also. This gap has been around $10 also. So how a strategy works in a volatile environment, this is called a market neutral strategy or a pair trading strategy, that we take both the oils, we compute their difference and see that what is the expectation, whether this price gap is going to increase or this price gap is going to decrease. So let's say the gap is right now $6 and we are expecting this price gap to increase, which means either Brent oil, which is 95, will go up, or WTI, which is 89, will go down, and this gap will increase. So what we have to do is buy, say, this oil is priced in dollar per barrel. So 500 barrels of oil, Brent oil, and short sell 500 barrels of West Texas. So you buy one, short sell another, and now if you see, I have a position where there are two oils, and both these oils, they move in a similar direction. Okay, they move in the similar direction. They mostly go up. If Brent is up by 2%, you will mostly see WTI also up by 2%. Same for the downside. So the question is, how you tend to make money out of this? First of all, the motive is that in a volatile energy market, you have taken buy position of Brent and short sell on WTI, which means now oil prices can go up or down, but your position is less vulnerable to this market volatility, right? Because if the market goes up, then you make money on Brent, you lose on WTI. But if it goes down, then you make money on WTI, lose on Brent. So your risk is very nearly hedged on that. But the only risk which you will face is the price difference. So if the price difference between this $6 price difference, if it goes down to 5 or 4, then you start losing money. But if this price difference grows up, which means, look at this position, if Brent prices go higher than WTI, then you will see a net profit in your position. This is how a pair trading works. Again, guys, this is something which is just an introduction of how pairs work. Obviously, I'm sure not a lot of you have tried these strategies on your platforms. And that's why I'm saying that do not just do it right away looking at the platform. Take your demo accounts, try on your demo accounts, talk to your consultants, come to the office, sit one on one, and then we'll explain you in the most easiest way how it is done, right? Uh, as far as the buying and selling is concerned, every buying and selling on this platform happens on margins. So if you see every transaction I have done over here, there is a certain percentage of margin block. And what is a margin? Margin trading is the process by which whatever value of stocks or commodities you have to purchase, instead of using your entire cash flow, You just pay only a percentage and rest is financed by the broker. Kind of how you buy a car. You pay a down payment and then you get an auto loan. Or if you're buying a property, you pay a down payment and rest you mortgage it, right, from the bank. So exactly how it works on the margin trading. Obviously, if you take high leverage, if you take high risk, so if you have put $100,000 in, so the question is, if you have put $100,000, can I trade more than $100,000? Can I take trade more than worth $100,000? Yes, you can. Why? Because everything you are purchasing, you are not using your entire money. You are just using fractional of your investment, and rest is financed by the broker. Okay. What does the broker earns out of it? Again, as I said, there is a certain charge over the leverage, which is in the form of holding cost. If you hold on to the position for day on day, they will charge you over that. But at the same time, when you use leverage, it increases the efficiency of your capital if you're using it right. So the consultants over here, they always tell you that how much leverage you should take. And what is actually leverage? Leverage is using borrowed funds to increase the returns on your investment. Now, guys, I'm sure a lot of these terminologies, again, I don't want to make it complicated, but these are few terms. Leverage, you should know the term itself, because a lot of platform providers, they tell you that these are leverage products. And if you don't understand what leverage is, then we might end up losing our capital. So it's really important for you to know this term. So this is one strategy where you can now just look at this. So first of all, look at this trade, gold short selling. Short selling we did on 1703.43, and right now look at the buying price. It is 703.14. It has come down by 20-25 cents. So your profit is around $7 to $8, right? Look at this. This is a small profit. You're actually making money from the falling prices. Again, it's a very small, insignificant profit. But this is just to show you that how you can make money from the falling markets if the trade goes in your favor. Uh, that to be said, every day trade should have a stop loss. If you're doing a strategy, then you should know that what is the worst it can go and what is the highest it can go. And definitely your consultants can help you out with it. As far as other trades are concerned, so we talked about taking a trade on an ETF. We talked about taking trade on wheat. If you want to just buy a share, it is as easy as anything. So let's say you want to buy Apple shares right away. You click on Apple, click here, click on buy. The order ticket gets generated. So one share right now is $155. If you want to buy 10 shares of Apple, it's worth $1,500. So you write the quantity, click on buy, and your order is placed. So if you see right now, you can actually, you just bought 10 shares of Apple at 155.59, and this is the current PNL. As long as you want to hold the stock, you can. I hope this is the easiest way to understand that how buying and selling happens. Still, if you guys have any problems, please reach us out and we'll definitely give you a one-on-one training session. Whether you are a client or not a client, it doesn't matter. Reach us out. Monday to Friday, the platform works. Saturday, Sunday, markets are closed. So during that tenure, we'll be definitely be able to help you out. So just to give you an example of Apple right now, you bought at 155.59. This is your buying price. And if your selling price is right now 155.74, slightly higher than your buying price, and you're making a very small profit of $1 or so. So uh, what we understood today, that you can diversify sector wise in a sectoral investing. If you're expecting economy to grow up, get moderate, if it is into recession, which are the areas to look into. I shared with you a portfolio of ETFs, bond ETFs, real estate funds, which have recently very good dividend yields. uh, Again, those stocks which have dividend yield doesn't mean that they are risk free. Of course, the capital appreciation and depreciation can follow. That can happen. So be very careful. Whichever stock you are buying or whichever stock you are selling, there will always be a capital appreciation or depreciation. Why that portfolio? Because the volatility, the fluctuation is less. That is what you need to be very much careful about. Somebody asked a question, that what is the view on Indian markets at the moment? Because so what we feel is probably, and I'm sure a lot of analysts are out there who feel that Indian markets probably in the second half of 2022, what we are looking at right now, should perform well as compared to other emerging markets like China, for example. Because even we see the entire year for most Asian economies have been troublesome, right? This is something which we have seen. Uh, most of the Asian economies have suffered. Uh, India has kind of been still an outlier when it comes to economic activity because the economic activity in India is still rebounding very sharply. GDP forecast looks good at this moment, somewhere around 7%, and it makes India one of the fastest growing major economies, right? We talk about foreign investment portfolios, it is increasing. I think it is somewhere around $30 billion easily, which we are expecting. So, and India has been very open. So when you compare India and China, you see right now Chinese stock markets show that they are not open for foreign institutions at the moment, and stock market continues to go down. India at somewhat level have been open to the types, have been open to the overall investment. So the local sentiment about the economy still remains strong, and again everybody has that core belief in the growth story, right? So this is something which we are looking at. It's one of the fastest growing economies at the moment. uh, During the COVID lockdowns, of course, we saw a decline in real estate, and again, a lot of people moved to remote working and other. But then, when you see the post-COVID change, demand for office space, for example. So if we look at the real estate sector, also the demand for office space have again started normalizing, right? If you look at the tech industry, also they have also moved to a very hybrid working model. Hiring is still very strong. A lot of companies are giving 5 to 6% dividend yield, right? Bond markets are still very hard for the international investors, so that is something which we need to be careful about. But then again, it is still a very significant part of our portfolio, and we should definitely look into it and do not discard it. So that is something which we should look into. Somebody asked a question about Adani Group also. Stock has been up 300% this year. um, I mean, it's a stellar return, without a doubt. And the whole reason I think behind the Adani stock, which it has gone up, there's been a high demand and consumption in power. But the stock was, anyways, already in uptrend. Their Q1 results were better. It was positive. But I still see another few reason is that Adani Enterprises, they have turned the Adani Group, the holding company, and they're getting a benefit of companies exposure in coal trading, in power generation and distribution business. And coal prices recently have appreciated to a very large extent, and this is going to help in the lowering of companies margin. So that's why a lot of market pundits have actually gone bullish on Adani Enterprises because of the coal trading benefit. So again, one of the reasons that why we have seen a continuous uptrend in the stock. But guys, as I said, please do not rely on one specific stock. Try to diversify among Indian funds also. And even on this platform, there are a lot of ETFs which are dollar denominated, which kind of protects you from the currency risk in a way. So you can always look into those sectors as well. Look into this portfolio. Anybody who needs, somebody asked that if you can share that portfolio, which we discussed about on the chat. So I can actually tell your relationship managers, and they will definitely do it. There's a question: can we trade Indian markets through Century Financial? Indian stocks are not available because CFDs and derivatives, there are no Indian equities available. Plus, from the whole cost point of view, if you do Indian equities in India, there are platforms which provide you absolutely zero commission. That's why the model doesn't work here. But through this platform, you can actually invest into Nifty. Let me show you right away. This is India 50 and it is dollar denominated. So if you're doing India 50 or Nifty in India, that is in rupees. Let me show the index here. We're doing this. indices. Yeah. Okay, not India 50, but I think, yeah, the fund, India 50 ETF, because that was a future contract. So, yeah. iShares India 50 ETF is there, and it's a dollar denominated fund. It's up by today 1.5%. And you can buy this in dollars, and this is $45 right now. And we can send you the holdings which this particular index has. So, definitely, if you have that account and you want to just buy and hold on to it, we have a tab with Indian brokers, interactive brokers also, which provide you a lot of exposure in Indian ETFs, and that will allow you to buy those ETFs in dollar denomination, right? So that is also something which we can do. Uh, Another question: can you share the portfolio? Can you share the portfolio? Yeah, definitely. So I think a lot of people ask for the portfolio sharing. That we can. Please talk to your relationship managers, and that portfolio can be shared with you with the bond ETFs and REITs. Please talk to your risk managers before you enter into any sort of investment. Come to us, talk to us, and only then, because every investment has a risk, every strategy has a risk. Even with this oil strategy, there are a lot more other pairs which we can discuss about. Come to our office, have one-on-one sessions, and we'll definitely, try to understand how we need to do it. There are a lot of strategies which are based on bonds as well. So if you want, so somebody just said you did not cover bonds. Uh, so as of now, we have a strategy going on in bonds. Uh, Basically, it's more like, so how you saw a pair between UK oil and US oil. There's a strategy where we are suggesting that you can look into buying US 30-year treasuries and short selling German bonds, solely because of the fact that Germany markets have still a lot of inflation to come, and if they have a lot of interest rates to go up, and that would affect the bond yields, and that's why the price is expected to come down. But at the same time, if you're only talking about specific bonds, I would suggest at this point, apart from the bond funds which I showed you in the portfolio, which have a dividend yield, you can look into specific bond market where try to link inflation with the bonds. So treasury inflation protected securities are there, where your bonds are actually linked with the inflation rate, and inflation is still increasing, and your coupons would increase. That is also available, but all of those bonds are not available on derivative based platforms. But if you reach out, so Century has a wealth division also, and if you're interested, then you can reach out to us, the wealth division, and we'll explain you that what sort of bonds you can do, uh, which normally are available, and you can look into the yields as well, because a lot of those bonds are actually giving a decent amount of yields as well. Uh, okay, what's your take on national bonds? Uh, See, again, it depends. Every single thing. Now, I can absolutely do a lot more research and try to find out any sort of bonds. And when it comes to the yield, we have to understand that whether the yield is doing justice to the inflation. Like, for example, corporate bonds at this moment related to Citigroup or any other could give you a 6-7% yield. There are bonds which are directly connected to the inflation, and higher the inflation goes, higher the coupon goes. So bonds is one of the safest investments, right? Because you get your money back and you get a coupon. A special approach on national bonds, because we are not able to provide national bonds through us, so we have very less research on it. But definitely, I can identify and create some research for you and definitely send it to you. So before giving you any sort of idea whether to buy or not, what we are mostly favoring is any bond which is connected to the inflation at this point of time. Another question is that how do we get dividend if physically don't buy shares or bonds? So important question, that on a CFDs platform like this, how do you get dividend? Because these are derivatives. So normally the market maker settles this. So example, if because on this platform you are short selling also. So when you are short selling your stock and if dividend is declared, that is deducted from your account. Similarly, when you buy a stock and if market maker is the counterparty, so they are selling it. So whenever the dividend date comes, the money is taken from the market maker's account and credited in yours. That's how dividend works in CFD. But if you want delivery of the stocks, then we have a tie-up with interactive brokers also, and you can actually buy stocks, have ownership of it. There are no physical deliveries anymore, but on your investments account, whenever the dividend is declared, it gets credited to your investment account. So it's your choice whether you want a derivative-based platforms for your stocks or you want actual exchange-based platform. Both of them will be available, right? So on a CFDs platform, as I said once again, that when you buy a stock, the market makers, they give you the dividend, and it comes in the form of corporate action, and every single time it gets credited. So that can be done. Apart from that, if you want a physical delivery of the share, you don't want to take leverage, then we have a type with interactive brokers, and that's where you can open your cash accounts and you will receive dividends just like a normal payment in your investments account. Can you share the portfolio? Yes, yes. As I said, portfolios can be shared. Please talk to your relationship managers and they will share the portfolio. And please come to us if you want to understand more and take demo accounts and do these strategies. And your relationship managers will tell you more strategies to look into. This is just one example because oil spreads have already moved higher. So at this point of time, we are not doing this strategy. But then like this, there are a lot of other instruments and pairs which are providing. There is so we used to do a lot of gold silver based arbitrage trades. We used to do a lot of oil based arbitrage. We used to do currently natural gas and low sulfur gas oil, which is also a current trade, gasoline based trades. All of this is there. Anything you need, I am readily available. My entire team is available. Please come to us. We'll have more sessions like this. We had one session last week on strategies. We had this session on diversification. We'll meet once again next week on a different scenario, on a different topic, and we'll talk. Even we'll include a few more strategies, a few more pair trading strategies by next week into these sessions. So if you want, you can attend those webinars. If you want, you can visit our office. We are in Emaar Square. We are in DIFC. Any single time, please let us know, and we'll definitely be able to help you. Before I leave, all the attendees who are present here, if you have your friends, your spouse, your relatives, any of your acquaintances, if they are in the healthcare sector and in medical field, a big word of thanks on behalf of my team in Century Financial, my family and myself. All of the people, first responders, nurses, doctors, midwives, they have worked so hard in the pandemic, and we are always indebted to their sacrifices which they have done. Pandemic is not completely gone. There are COVID different versions always running, and I absolutely salute the courage of those who are fighting and responding all the healthcare sectors. So if you have your friends, please convey my regards. If you are one of them, thank you so much. With this, I end this session. If you have any further questions, please reach us out. We'll meet next week for another webinar. My name is Yogesh. If you liked our session, please review us on Google, Century Financial Reviews, and share your feedback. Let us know if you want to make it much more easier. And please, if you feel that session is complicated, you want to have a one-on-one session with me, we'll break it down completely for you and make sure that you understand each and everything. So thank you so much. You have a great night ahead. Be healthy, be safe, and continue to invest. Thank you.